Hey, how's it going, everybody? Welcome to Finance with Avon. In this video, I want to just go over this awesome article that I stumbled upon while I was just doing some financial research. This article by BlackRock, the largest institutional investor in the world. One of the best articles I've seen as far as like an overview of a year and a prediction outlook for the next year. Some great advice and information and details in this article for sure. So I'm gonna have it linked down in the description. It's not a referral link or anything like that. Just so if you wanted to actually read this and take some time to really dig into it some. And so they call 2023 a humbling year for many in the asset management business because in the news, you saw a lot of headlines of recession this, recession that, just kind of invoking fear into the market throughout 2023. Recession is going to hit, stocks are going to crumble, all these things like that. And then there was a lot of skepticism about the Fed being able to actually perform a soft landing. Many people thought it was going to be a hard landing. It was going to be a shock in the economy, shock in the markets. And yeah, we did have some, rough areas in the market, like October 2023 was a great buying opportunity. However, the U.S. economy was surprisingly to the upside. The S&P finished the year at 26.6%, and the tech-heavy NASDAQ jumped to 43%. So major double-digit gains overall in those indexes in 2023, above the averages of the gains in those indexes. So this 2023 was a year that took a lot of people by surprise when they thought stocks were going to perform kind of rough. Recession is going to hit. It's going to affect earnings really negatively for companies and, going to drag down the gains and things like that. However, definitely not. Yes, there were a lot of gains concentrated in that Magnificent Seven. As you see, there were other stocks that had major gains around that amount and more as well. So overall, if you were invested in these indexes, S&P 500, NASDAQ, you did well. And definitely if you were invested in those individual stocks that did very well as well. And I'm going to talk more about that because this article mentions that as far as like ETF and index investing in individual stocks. And as they state right here, 2023 was a year with some very big winners. Like I was talking about the Magnificent Seven. Those stocks were up an average together 105%. Facebook Meta platforms, Apple, Microsoft, Amazon, Tesla, Nvidia, and Google Alphabet. The Magnificent Seven, that's an average of 105% in 2023. That is amazing. In 2023, a lot of people thought, oh, okay, I need to hide out in bonds. I need to hide out in cash. Stocks aren't going to perform well. If you did that, you likely underperformed, especially if you were underweight in the technology sector. As stated right here, having index exposure alongside those alpha-seeking managers allows you to swing for the stars while still maintaining exposure to the broader universe in case markets throw you a curveball. So this statement right here is really important because while, individual stock picking, I like to do that. While you do want to, try to find those massive gains, those massive 3-digit, maybe even 4-digit, nice, high, solid 2-digit gains, in these mid cap, large cap, maybe even mega cap companies, if you have that exposure also to the indexes, you're going to have that safety along with the market to ride out. So like, for instance, if you swung for the stars and just picked, 5 individual stocks and they weren't part of that Magnificent Seven, maybe you had one of them and you had 4 other duds or 4 other kind of meh stocks, then you didn't perform as well as the market overall. However, if your portfolio was kind of mixed, you had the index, you had the S&P in there, you had a NASDAQ like the QQQ ETF or some other, NASDAQ heavy in ETF or some other NASDAQ heavy ETF or the index of the NASDAQ, and then a couple of those other stocks, maybe in one of the Magnificent Seven, maybe those other duds or something like that, well, then you performed better. You had that safety of that index exposure along with those, really high flyers that you were trying to get gains from. Maybe you did get some high flyers, maybe you didn't. But however, since the market performed so well, that 20-something percent, 50, 40-something percent, you had that index exposure, which helped your portfolio do better. As you see right here, 2023 returns, if you're just sitting in cash, that's a yield right there, 4.6% is an average. And if you paid attention to my channel throughout 2023, you definitely know I've been talking about high yield savings accounts and CDs throughout the year and give you those rankings of the high yield savings accounts and CDs and talking in depth about certain accounts. And the cash right here, that 4.6% for this chart is defined as an average money market category return. So the money market account similar to high yield savings accounts. And you have the aggregate bond index 5.6%. There's the S&P at 26.3%, tech stock 61.1%, and that Magnificent Seven right there at 88%. In this part of the article, I like a lot as well. Market timing is really hard and your gut is often wrong. As you see right here, they state 2023 was a hard year for market timing. Investors were net sellers of stocks through the first half of the year, even as the S&P rallied by 17% through June 30th. So net sellers mean you were selling more than you were buying. Just dollar cost average throughout the year, a certain amount, and just every month, every week or something like that. then you're buying stocks when they're at their lows, and also when they're at their highs sometimes, for sure, and also when they're at their middle. But you're getting that nice average as the market is going up month over month or year over year. You're getting the average price for something instead of just dumping all your money in at a certain time when you think it's a good time to buy, or when you're panic buying or panic selling, or getting caught up in the hype and buying through that, or panic selling or something like that. Just dollar cost averaging throughout the year, not trying to time the market. If you want to even try to time the market, just what I like to do basically is dollar cost average throughout the year, and then buy extra during those rough months, during when the fear and greed index is at fear or extreme fear, when things are looking kind of shaky in the market. And that's when I like to look for stocks that are undervalued, that I have done research in, that are on my watch list, or that I already own, that I want to own more of. So yeah, there's definitely, I won't say don't try to time the market, because if you have the right mindset emotionally and everything for it, you can somewhat time the market. However, if that's not something you're willing to do as far as the research and paying attention to the market inflows, outflows, the news, institutional investing, the cash flow, the earnings, things like that, then just dollar cost averaging throughout the year is the safest, more risk-free, hands-off approach to investing, where typically you're going to do well and outperform a lot of even active investors who are in and out of the market. And this is going over bond investors, which I don't do much bond investing and everything. However, this is a section right here. If you're interested in bond investing, I would definitely look more into that. And don't fight the Fed. That is something for sure that I've said before to people, is don't go against what the Fed is doing. Don't think you can outsmart the Fed or outdo the Fed or anything like that. They are high level what they're doing. They know what they're going to do before they're going to do it. They know what they're going to try to do with the economy, with the markets, things like that. Typically, a lot of people are wrong when they assume things about the Fed, unless the Fed's pretty much laid it out, and Federal Reserve, unless they've just laid it out for you, basically. Trying to outsmart, outmaneuver the Fed can often end in you making wrong calls, wrong moves. As they stated right here, we have historically seen bonds deliver the strongest returns in the period between the Fed's last hike and first cut. If you wait for the Fed to start cutting, you may be too late. Some people are trying to time when the Fed were doing things, trying to get ahead of them with the hikes, and now trying to get ahead of them with the cuts and things like that. Like people thought, oh yeah, there's no way the Fed could do the soft landing. There's no way. It's going to be a hard landing. As you see, it kind of looks like they may have actually done the soft landing so far. I mean, it's still early, not early innings as last year, the year before, but so if you would have betted that the whole time in 2023, would have definitely missed out on some gains. Another nice section of the article right here, 3 market predictions for 2024. And what they're saying right here makes a lot of sense. It's not just a bunch of just guessing or luck or anything involved in this. Actually makes sense what they're saying right here. So let's go over these 3 market predictions for 2024. They state that stocks and bonds deliver positive returns and cash underperforms both as the Fed pivots to rate cuts. So the Fed has pretty much hinted at and stated 3 possible rate cuts in 2024. And I talked about that some in my video, federal funds rate versus the saving and CD rates. So definitely check that out if you're interested in how historically the Fed funds rate hikes and cuts have affected CD, certificate of deposit, and savings rates. Very interesting. I'll leave a link down in the description for that if you want to check out that video. However, this right here is talking about more stocks and bonds. So what they're stating is stocks and bonds may be poised for success in 2024. Easing inflation and a pivoting Fed should reduce headwinds that have faced both asset classes in recent years. Resilient growth may prove to be an additional tailwind for stocks, and bonds could benefit if interest rates fall further ahead of expected Fed rate cuts. On the other hand, cash may be getting less attractive. With the Fed forecasting 3 interest rate cuts in 2024, we could start to see cash rates fall as soon as March. Unlike bonds, cash does not benefit at all from falling rates and simply delivers a lower yield, which is exactly one of the things I talk about in that video, federal funds rates versus CD and savings rates. I won't even say cash has been king in 2023 because you saw how the indexes in the stock market performed, the S&P and the NASDAQ and even the Dow as well, all double-digit gains, which is more than you would have gotten in a high-yield savings account with your cash. But however, I'm not saying don't have your cash in a high yield savings account. As you may know from some of the videos I do on my channel, I'm a big fan of high yield savings accounts and certificate of deposit accounts, especially in these economic environments where you're getting a nice high yield for your emergency savings. However, I do often state not just to have all your money in a high yield savings account or CD account. In emergency savings, yeah, some lump sum of money you don't need to touch. Maybe you want to keep safe, the principal, but you want to make some gains that you want to know about, the yield on them, everything like that. Yeah, CDs, high yield savings all the way for sure. But definitely be invested in the stock market throughout, because that's often where you're going to have better gains than the cash that you're yielding in that account. But definitely have a high yield savings account better than a traditional savings account or something like that for sure. So with the Fed having those cuts, that's going to come along with there being cuts and declines in high yield savings account yields and CD yield. And I've already started to see that in high yield savings accounts and CD accounts. So I do videos every other month on high yield savings accounts ranked by APY and CD accounts ranked by APY. And I've noticed that yields have started to get a little steady, as far as like they've started to not move as much. Whereas before last year, every month or so, you had 0.20%, 0.50%, 1% gains in high yield savings accounts just every other month, or some companies were raising theirs 0.25% or so every month. It was just really just raising up. However, now I'm seeing a little bit more steadiness and even some lowering of rates recently. So I've noticed a couple of companies lowered their high yield savings account by like 0.10%, 0.15% or so, things like that. So not major amounts where it's like, whoa, but a little bit. I've started to notice that already with rates falling a little bit, not as much as they're probably going to fall the rest of this later this year, but somewhat, definitely not raising recently. I haven't noticed many raises in yields in high yield savings accounts and CDs, but definitely some more leveling, some more stagnant, and little declines as well. So while cash was a little bit more attractive in 2023, still going to be nice to have a high yield savings account in 2024, and even a CD account if you like to have that. However, people that haven't been allocated in the market have had maybe too much cash, they're going to be looking to put that cash elsewhere, especially if rates start to fall more noticeable in their accounts. If they notice like, oh, I had that same account, same amount of principal in my account, and my interest this month was less than last month, even though it's compounding interest, somehow still went down. Oh, look at the yield. Oh, it's lower. So, things like that start to happen. Oh, I need to move that money elsewhere, something like that, or not put as much in my savings as before. So things like that will start to happen, as well as for treasury bills. People that have been invested in those may not start being as invested in those and want to go into the market more. In the next prediction for 2024 from BlackRock, they state that diversifying alternatives take center stage as bond yields fall and interest rate volatility spooks investors. So they state, falling interest rates make for attractive bond returns, but we do not expect the fall to be a straight shot from here. The 10-year U.S. Treasury note kicked off the second half of 2023 yielding a 3.85%, then rose to a high of 4.99% before falling back to finish the year at 3.88%. This volatility could continue into 2024 as markets digest growth and inflation data. The combination of high coupon rates and yields that are more likely to fall than rise should make for attractive bond returns, but investors will likely want to manage that interest rate volatility and the risk that longer-term interest rates rise with a healthy allocation to diversifying strategies that may still be able to deliver attractive idiosyncratic returns. Our highest conviction ideas here include the BlackRock Strategic Income Opportunities Fund, BlackRock Global Equity Market Neutral Fund, and the BlackRock Tactical Opportunities Fund. BlackRock, recommending their own funds, it's kind of funny, but the thing about these funds, I want to dive into them a little bit to show you what they mean by alternative investing. With these, you got the Strategic Income Opportunities Fund. So let's see, what are the main holdings in this fund? What makes this different than just holding an S&P index or NASDAQ index or something like that? So this fund right here states that it is a flexible bond strategy that seeks to offer investors attractive income, returns, and meaningful portfolio diversification. So this one right here, exposure on this one, you got non-U.S. sovereign, non-U.S. credit, emerging markets, U.S. high yield credit, non-agency mortgages, commercial mortgages. So you got a mix of the mortgages, the real estate, the credit markets, the treasury markets, and then you see exactly like some of the top holdings. Uniform MBS, so it's mortgage-backed securities, so that's at 10.34%, and you have the United States Treasury at 5.08%, Kingdom of Spain right there, 1.68%. You got JP Morgan Chase, Morgan Stanley, some other major institutions right there in this income opportunities fund. So that is an interesting take right there on some alternative investors. And then you also have, let's jump into the global equity market neutral fund, which, you can just tell from the name of this, what its, goal is, what its main approach is. So the global equity market neutral fund is a market neutral strategy which seeks true diversification and consistent returns through innovation in a technology driven investment process. So let's see what this one is mostly invested in. Top holdings, Invesco S&P 500 equal weight ETF. So equal weight ETF is basically where you got the same amount percentages in each holding, whereas A regular index would have different amounts. Like this index right here, it's like this ETF right here. You got 3.64% right here, 1.96% right here, and so on and so on. Equal weighted would be like all of these having, if you got 10 holdings, all of them having 10% as far as the fund weight, the percentage of the fund that they are. So here you have Visa, they have in this holding as well, Novo Nordisk, Coca-Cola, Nvidia, Amazon, Moody's. So see some of the diversification going on here for sure. You got technology, consumer discretionary, financials. Okay, an exposure breakdown. You got industrials, consumer discretionary, information technology, and healthcare and financials. Geography of this one: North America, Europe, Asia, emerging markets, and then holdings in cash and derivatives. See that one? So yeah, that's the Global Equity Market Fund. And then the last one, the Tactical Opportunities Fund. They say that this is a macro strategy that tactically allocates across global markets and asset classes and has achieved lowly correlated stable growth. And what I like to do with these ETFs, definitely before you invest them, is look at how they performed historically. I'm not doing a deep dive into these ETFs because that's what I would definitely do. I'm not recommending these ETFs at all. I just want to show you what they're kind of recommending with their predictions of 2024. These holdings right here are top holdings. You got Apple, Treasury bills, Microsoft, Treasury bills, and so on. You see that? You can kind of go on on that. So Procter & Gamble, Nvidia, Amazon, Treasury bills. And so this one is kind of like just a mainly S&P, big cap, mega cap type of holding right there with those Treasury bills mixed in for sure. Tactical Opportunities Fund also states it seeks to capitalize on a dispersion across countries by investing in equities, bonds, and currencies. You got a lot of major, large cap, mega cap companies as well. Then you have that mix thrown in of Treasury bills, and then you have that mix thrown in of bonds and things across the currencies. So you have a mix of investments. So it's not just like reaching beyond just companies and large cap companies and mega cap companies. You got those for sure because typically those are going to give a lot of gains as well. But it's like, okay, there might be some thinking like there is no way these companies could have as much gains as they did in 2023. We had to look a little elsewhere for some more gains. So a little backup kind of strategy. It seems like what these three funds, these three ETFs are kind of presenting to you right here. So not something that I'm that interested in as far as like investing in bonds and currencies as much. Global for sure, like investing more in emerging markets and things like that. I definitely think that's a good approach when you're diversifying your portfolio. If you find out you're too heavy in the US, I definitely would not leave the US as far as investing. Definitely still stick with, S&P 500, NASDAQ, and so on and so on. But throwing in some emerging markets, some global exposure for sure could be a good thing and I think just not in 2024 and beyond, and last year and the year before, and just so on. And the third and final prediction by BlackRock for 2024, they're stating a broadening equity rally creates opportunities, and at least one big winner in 2024 will take the world by surprise. And as you know, if you've been paying attention to markets, first half of the year mainly was driven by technology gains. And then you had a lot of the rest of the market start to catch up with the gains that those big Magnificent Seven, those technology stocks were performing in 2023. You had other sectors and other companies playing catch up somewhat. So right here it states the equity rally broadened beyond technology stocks in the second half of 2023, but dispersion between the market's big winners and losers remain. We expect the market dispersion to continue, creating opportunities for active managers to take advantage of. So you're going to see companies that are undervalued that have been somewhat overlooked because, everybody's just jumping on to the hype, the companies that are really performing, that are taking all the headlines, and that there's only so much money to be allocated that goes around. So you're going to have companies that are performing well, that are having solid earnings and everything, but they just don't have as much interest, as much investment in them. So they're going to be undervalued. The PE ratios, the price of sale ratios are going to be on the lower end. So it's going to create opportunity, of course. That definitely happened a lot in 2023. And, it's definitely something to take advantage of. But, you want to have those indexes just to ride it out, dollar cost average of that. But if you want to have some individual stock exposure, you might want to look for those undervalued companies to add to your positions or even, start a new position in. And it states right here, favorite potential winners from Gargi Chaudhuri, I hope I'm saying it right, apologize if I'm not, head of iShares investment strategy, include smaller cap U.S. equity companies, as well as companies in India, Mexico, and Japan. She also sees opportunity in sectors that underperformed in 2023, such as healthcare and financials, as areas that could benefit due to attractive valuations. Healthcare didn't perform as well overall in 2023 as communication services and information technology and consumer discretionary did. Financials had some moments here and there in 2023, but did not perform as well as those, top three as well. So there definitely have been undervalued companies in those sectors, and there will continue to be, and that creates opportunity. Small cap U.S. equities could be an area of opportunity as well. As I've noticed, and as I've noticed the Russell 2000 index, which is composed of the smallest 2000 companies in the Russell 3000 index, it's kind of hanging out steady the past few years. Yeah, there's been ups and downs, ebbs and flows, but you look at where it's at, for the year to date. It's only been a couple weeks in the year right here, but you look at it for a year, it was definitely low. October area right there. I mean, I made a post on the channel in the community section. I made a video about it. I was like, October, this extreme fear that's creeping up on us. I think it was towards the end of September when I started those videos. I was like, this is going to be a good buying opportunity, it seems. But yeah, so that was creating an opportunity, still is creating an opportunity. If you zoom out, get the 5 year, just kind of steady. The Russell 2000 is kind of meh. That's the COVID right there, area right there. But zooming out even more, you see, could be an area of opportunity as far as how it's been kind of riding up, kind of going sideways and riding up. So that is something I've actually kind of looked at as well, thinking about adding a small cap ETF to my portfolio that's composed just of ETFs. But that is an area of opportunity that is stated in here in this article, as well as companies in India, Mexico, and Japan, emerging markets. So that may be, an area of opportunity for sure. That was kind of mentioned a little bit in that other prediction with some of that. And it also states right here, these parts of the market could very well soar. However, I believe that at least one big winner will take the world by surprise, not unlike the big AI names driving the markets in 2023. As was the case in 2023, it's prudent to maintain some broad equity index exposure just in case something else captures the zeitgeist. For an investor seeking broad equity index exposure, consider, and they give some, recommendations on broad equity exposure. So broad equity exposure, that's if you're just pretty much invested like in an S&P 500 or, something that's going to cover a wide range of the stock market. And that, like I was stating earlier in the video, definitely want to have that just in case, because you don't know where the market's going to go. You don't know where these individual stocks are going to go. You zoom out, like overall the S&P 500 is a great place to be invested, just to stay invested, not trying to time it, just being long-term invested in it, and something that falls in the index, in technology stocks, in the NASDAQ and companies like that, even in the Dow. You just zoom out and like, okay, yeah, sticking with these indexes, sticking with ETFs that cover the indexes, low fees as well. Definitely check out the fees. Make sure you're not paying too much in fees. Compare the indexes, compare the ETFs for sure. And there's just a place to kind of hide out in, not really hide it out in, because you want to definitely be exposure there. You don't want to be ashamed, nothing to be ashamed of, to be investing in ETFs. And that's going to give you that broad equity exposure so you can capture these double-digit gains like in 2023, and maybe the single-digit gains. And yeah, there's going to be years where it's not that many gains, but overall. And then also look for those areas of opportunities in individual stocks and individual sectors and things like that. So they do state that there could be a big winner. Like AI was a big driving factor in 2023 with the NVIDIAs and AMDs, Alphabet and Microsoft and all of that. AI was like the hot word of the day. You say that in your press conference and your earnings call, a few times, and your stock jumps up 5-10% or something. But yeah, so you may have something like that in 2024 where there's something else driving the market. Maybe it'll be AI again. Maybe it will continue. Maybe we'll notice AI actually being more involved in earnings and things like that. However, there could be something else. So to capture that something else and to capture also that AI, possibly the continuation in technology, be invested in the indexes, for sure, but also look for areas of opportunity. I like this wrap up right here and the end as well. And I talked about this before on my channel, before I even saw this article for sure in my videos about ETFs and individual stocks and things like that. But they're stating right here, the key takeaways for portfolio constructors: balance and diversification. Two things I'm major on. Balance for sure. Like if you know me personally, you're like, oh yeah, I get it, Avon. Balance, I know. But yeah, I know a lot of you don't know me personally. But yeah, balance for sure, and diversification. If you were underweight stocks going into 2023, now is a good time to at least get back to benchmark. And what I mean by benchmark is get back to these indexes, get back to getting closer tied to the S&P 500, to the Dow, to the NASDAQ, things like that. That's what I take it, because typically when ETFs talk about benchmarks, they're comparing themselves to a benchmark, which the benchmark is the indexes. So yeah, and they state right here also, we see plenty of opportunity for active managers to deliver alpha in 2024, but suggest seeking balance between active managers and core index exposures. We look to high convention stock pickers, flexible bond managers, and idiosyncratic alternative strategies to drive better portfolio outcomes in 2024. And that's it. And it's simple. Like that part right there, simple sometimes needs to be stated. And it's nice to see it stated by a company as large as BlackRock. Be invested in the indexes, But also, you know, you may be able to find some individual stocks that are undervalued, some high conviction stocks, you know, that may drive some things, some alternative strategies. You know, just good to try different things, but don't stray too far away from being tied to some indexes as well, because you can't just completely time the market. You can't completely pick the market. You know, a lot of people can't, and that's okay. But the market is so vast, it's so great that you can just, if you just have balance and diversification and patience, they don't mention that, but definitely patience, the mindset, the emotion, whatever it's going to take you to say, hey, I'm going to keep putting $100 a week, $10 a week, whatever, $500 a month, $100 a month, whatever you can do into the stock market. You know, whether it be, okay, I'm going to do all indexes and ETFs, or whether it be, oh, I'll do 75% indexes, NTFs, and 25%, you know, individual stocks. Also keep the cash as well. Whatever is going to take you to make it consistent, to keep doing that week after week, month after month, year after year, and you'll see those gains. You'll appreciate it. Sometimes you'll appreciate it months from when you started, months from when you're making this progress, making these actions, making these goals. Sometimes it takes years. Sometimes it's weeks. Sometimes it's like, wow, great thing I bought that. But then you don't say like, oh, I just sit on it, wait for it to pull back. You have to keep buying it, even though it rolled up 50% from where you bought it, because it may roll up another 50%. It may dive down 25%. It may dive down 75%. And then hopefully you won't say, oh no, I need to sell, I need to get out of it. If it's still a great investment, that's where you go, oh, yeah, I should buy more of it. So yeah, great article here by BlackRock and Carolyn Barnett. Good job on the article. Really like what it's giving you, the details, the wrap up of 2023, kind of the predictions for 2024. Like I stated, it's not something that I'll say I'm going to follow word by word. Some things I do definitely like I have already been doing that I will continue to do. And some things I'm just like, oh, maybe it's not for me. And that's fine. That's, you know, that's how investing is. But yeah, hope you all enjoyed the video. Take care.